friends, as I have promised you that I'm going to be discussing about the two of the stories which are developing on both debt space as well as equity space in the current market context. Unfortunately, most of the investors are ignoring it because they have become extremely risk averse. If we are not able to take opportunities which are knocking on our doors currently, then we will not be able to manage to generate wealth for us when such opportunities come by very rarely. There is a story developing, as I said, both on the debt space and on the equity space, and that's the investor's dilemma, jaye to kahan jaye. This is part 1 of that video. I am going to discuss only the debt opportunities currently because I have already spoken on the equity opportunity on social media and on my webinars also. So let us concentrate on the opportunities available in the debt space and why is that an opportunity in spite of RBI having cut rates recently. As we know, there is a reverse correlation between debt and equity. When equity generally tends to do well, debt is supposed to underperform and vice versa. But after many years, both the stories are developing because equity valuations have become cheap, and at the same time the macro factors which are positive for debt is what we will discuss in this particular video and in subsequent videos also. Different asset classes perform differently under changing macros. Equity generally performs well in expansionary economies when the country is doing well and on the growth path. As against that, when the country is contracting or in a recessionary phase, debt generally performs well in contracting economies like the current one. Positive measures by RBI, all of us are aware of the positive measures undertaken by RBI, including continued accommodative stance with substantial rate cuts which were declared on 27th of March 2020. Massive liquidity infusion. At the same time, they have pushed banks to borrow in the LTRO, which is the long-term repo operation, at repo rate of 4.4% and start investing or lending in the 1 to 3 year segment. And this is what should kickstart the buying spree in the current month, which is the month of April. Worst month of March 2020 is behind us. RBI rate cuts and an impact on debt yields. So far, maximum impact is at shorter end of the curve, which is 1 day to 3 months. Transmission at medium term to long term has still not happened, as all of us can see that the interest rates or the yields which were available just about a month back in 5-year AAA bonds, which was at 6.5%, has currently come off marginally to 6.4%. But the spreads have widened, and the reason behind spreads widening from 135 basis points to 200 basis points currently is because the repo rate cut was very substantial. So from 5.15% it has gone down to 4.4%, and as against that your yield has only come down from 6.5% to 6.4%. So that 200 basis point differentials in the corporate bond segment is what we need to capture in the current debt space. This is the story which I am talking about, which is evolving and will continue to evolve going forward also. Thank you so much. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.